Greetings and a warm welcome to Forex channel. Prepare yourself for an extraordinary journey as we delve into the realm of cutting-edge strategies within the dynamic world of financial markets. Brace yourself, for this video holds the power to elevate you to the esteemed status of a seasoned and proficient trader. Pause whatever tasks you may be engrossed in and graciously grant me your undivided attention. I assure you, dear viewer, that this captivating presentation will revolutionize your destiny within the boundless realm of financial markets. First and foremost, we will unravel the intricate concepts of demand and supply within the market structure, shedding light on the crucial role they play in smart money trading. Additionally, we will delve into the concept of liquidity, examining it through the lens of intelligent money strategies. Moving forward, we will present a comprehensive trading plan that encompasses 3 exemplary smart money trading strategies renowned for their effectiveness. Prepare to be introduced to the art of sniper entries, where precision and calculated decision-making reign supreme. These strategies will empower you to seize opportune moments with unwavering accuracy, maximizing your potential for success in the markets. Let's start with supply and demand. Supply or demand is a zone where price rapidly pushes away, creating inefficiency and a break of structure or change of character. There are 3 factors to consider when identifying supply and demand areas for trading. Did it create inefficiency? Did it break the structure or change the character? Did it create liquidity before the zone? Did it create inefficiency? Did it break the structure or change the character? Did it create liquidity before the zone? So what is the inefficiency? Inefficiency occurs when we have gaps between the candles, and when it happens, price is more likely to come back to this area to fill the gap. What are break of structure and change of character? A break of structure is formed in a trend continuation. Every time price breaks a structure level in the same trend direction, it signals a trend continuation. On the contrary, when price breaks a structure level in the opposite direction, we call that a change of character, which signals a possible trend change. Change of character supply and demand zones are most effective when they break through 2 or more supply and demand zones. Change of character forms after a higher time frame mitigation. Price impulsively breaks through the zones with a few large candles. Liquidity refers to the ease with which an asset or security can be bought or sold in the market without causing a significant impact on its price. In the context of currency trading, liquidity represents the availability of buyers and sellers in the market. When smart money, large institutional investors or banks, intends to buy a substantial amount of currency pairs, they require a sufficient number of sellers in the market to execute their trades. The conditions that facilitate the execution of these trades are referred to as liquidity. Let's consider a scenario where the market is in an uptrend. In this situation, there is generally a higher demand for the currency as more market participants look to buy. However, if banks or institutional investors want to buy a significant volume of currency pairs, they need counterparties willing to sell. In such cases, when the price approaches a support level before reaching the desired demand zone, that support level becomes an interesting area for support and resistance traders to place their buy orders. Interestingly, the stop-loss orders of these traders are often located below the support level, resulting in sell orders. This setup creates an opportunity for smart money to enter the market by triggering those sell orders and subsequently placing their buying positions at more favorable prices. Here are some important points about liquidity. Liquidity zones provide additional confirmation for executing optimal trades when they form above or below a trading zone. These zones are areas in the market where there is a significant concentration of buyers and sellers, resulting in increased liquidity. Types of liquidity. While there are various types of liquidity, one key aspect traders primarily focus on is the presence of equal highs and lows. These levels often indicate areas of interest for market participants and can contribute to increased liquidity. Stop losses and liquidity. Stop losses play a role in defining liquidity. Wherever stop loss orders are placed, liquidity is also present. This is because stop loss orders represent levels at which traders are willing to exit their positions, thereby adding to the liquidity of that particular price level. In summary, liquidity zones offer additional confirmation for executing trades, and equal highs and lows are important indicators of liquidity. Stop losses define areas of liquidity in the market, as they represent levels where traders are likely to exit their positions. Order blocks are specific price levels on a chart that represent optimized supply and demand zones. They are areas where there was a temporary imbalance between buyers and sellers, resulting in a significant price move. When identifying order blocks, traders typically focus on the most recent candle that created the inefficiency, regardless of whether it was a bearish or bullish candle. This recent candle is considered an order block zone. Outer order blocks are important because they represent areas where institutional traders or smart money may have executed large buy or sell orders. These zones tend to act as support or resistance levels in the future as market participants remember the imbalance that occurred there. By recognizing order blocks, traders can gain insights into potential future price movements and use them as reference points for making trading decisions. The presence of order blocks can help confirm the validity of support and resistance levels, as well as contribute to overall market analysis and strategy development. In summary, XAUUSD are commonly used to identify order blocks in two conditions: when the order block candle has a larger wick than its body, indicating a strong rejection of price at that level and suggesting a potential order block; when the wick of the following candle extends beyond the high or low of the order block candle, indicating a price reversal or retracement from the order block zone and triggering stop-loss orders of traders who entered positions based on the order block. These conditions signify notable trading activity and potential supply or demand imbalances at the order block zone. Traders pay attention to these wicks as they provide insights into potential price reversals or continuation patterns. By identifying and analyzing these order block conditions, traders can enhance their trading strategies and decision-making processes. To validate an order block, there are 3 rules to consider inefficiency. The order block must exhibit an inefficiency in the form of a strong rejection or imbalance between buyers and sellers at that level. This inefficiency indicates potential significant supply or demand, break of structure, or change of character. The order block should lead to a break of market structure or a change in the market's character. This means that the price should exhibit a significant shift in direction or sentiment, indicating a potential trend change. Unmitigated. The order block should be unmitigated, meaning it has not been tested by the price yet. The price should not have revisited or retested the order block level since its formation. Unmitigated order blocks are considered more reliable as they have not been influenced or weakened by subsequent price action. It's important to note that order blocks are typically considered one-time use. Once a valid order block has been tested or mitigated by price action, it is no longer considered as reliable for trading purposes. The next topic is the market structure, supply or demand. Who is in control? Imagine this is a 1-hour structure and the price reaches a demand zone, so it would be wise to look for buying opportunities. In the scenario where the price comes from an unmitigated 4-hour supply zone, supply side is considered to be in control. Therefore, trading the demand side without confirmation is not recommended. It is important to wait for confirmation that the supply zone has been overcome or invalidated before considering a trade. This confirmation could come in the form of a strong breakout above the supply zone or a reversal pattern indicating a shift in market sentiment. By waiting for confirmation, you can ensure a higher probability of successful trades and reduce the risk associated with trading against the dominant market trend. It is indeed important to consider where the price came from when assessing potential trade opportunities. In certain scenarios, you can consider a risk entry. The price broke through the supply level, providing a bullish bias on higher time frames. If the price breaks above a significant supply level, it suggests a shift in market sentiment and a potential bullish bias. In such cases, you can consider taking a risk entry in anticipation of further upward movement. The price broke the structure but has not reached the unmitigated supply zone yet. If the price breaks the market structure, indicating a potential trend change, but has not yet reached an unmitigated supply zone, it can present a risk entry opportunity. This scenario suggests that there may be a temporary imbalance in supply and demand, allowing for a potential trade in the direction of the newly formed trend. Now let's have an example to explain how to establish which side is in control. Look at this example. Light red zone, supply is in control. Light blue zone, demand is in control. We broke through the minor supply, forcing demand to be in control. After the price rejected on the major supply caused the supply to be in control again, we expect price to come back to the extreme of the demand that created an impulsive order flow which caused the minor supply to be broken. Finally, we wait for a flip that makes demand in control again. So next we have the trading plan. For the following strategies, we recommend choosing only one pair to trade in only one session. London and New York are the best choices. You should master the chosen pair by back testing the heck out of it. Start by going back a few months on the chart and back test every single chosen session. Personally, we only trade euro-dollar and opening the New York session for about 3 hours per day. The reason is we started to trade Forex for financial and time freedom. So why would we spend 8 to 10 hours a day on the chart then? Remember, every session has more than enough opportunities every single day. Now let's jump into the trading plan. The smart money trading plan consists of 2 steps. First, we analyze the market structure in higher time frames to find market direction, who is in control, optimal supply and demand zones or order blocks. Second, we observe lower time frames to execute trades based on 3 types of entry patterns, including D, supply or demand flip, change of character, continuation. Analyzing the market structure in higher time frames. As I mentioned before, we only look for 2 factors: market direction, who is in control, optimal supply and demand zones or order blocks. Look at this example of euro-dollar for hours time frame. Starting from the left, we can see that we have a break of structure with inefficiency, so we have an order block. Then price pushes to the upside with inefficiency, but since it could not break the structure, we will call this a demand zone. After that price broke the demand zone to the downside, we can now say that supply took control. Once again, we had inefficiency with a break of structure, so we marked the new order block. And this zone would make a perfect selling opportunity, and our target would have been the next unmitigated order block. Now it's time to explain our entry setups. In the second step, we observe lower time frames to execute trades based on 3 entry patterns. The first one is called the supply and demand flip. In this pattern, price creates a new high, and it tests the last demand zone and pushes away from it, but fails to create a new higher high. Instead of creating a higher high, it broke through the last demand zone with an impulsive move, leaving a supply zone behind price, retested the supply level where we put our limit order and opened our position. But remember, this pattern is most effective when the price aggressively pushes away from demand and supply zones and rapidly breaks through the last demand zone, leaving inefficiency behind. So let's move on to the next setup. We call this change of character pattern and tapper. This pattern forms after mitigating a higher time frame supply or demand, meaning that we always trade this pattern if we have the market in our direction in higher time frames. Here, our higher time frame direction is bearish. After mitigating the supply zone, our short-term trend changes the character with inefficiency, leaving a perfect supply zone. So when the price gets back to this level, we will execute our short entries. So let's move on to the next setup. This setup is called the continuation pattern and ATS. So we only trade this pattern when we have a clear trending market every time market makes a valid order block with all the rules we discussed earlier. It is an opportunity to place a trade only if we have both higher and lower time frame direction on our side. But remember, market will give you a lot of entries while trading this pattern, so you have to manage your risk carefully. CHoCH is an attractive broker that offers a range of trading services. Their website, CHoCH.com, provides a user-friendly platform for traders. One notable feature is their live chat functionality, powered by live chat, which allows users to have real-time conversations with their customer support team. If you're interested in registering with CHoCH, I recommend using the registration link provided in the website's description. By clicking on that link, you will be directed to the registration page where you can sign up and create an account with CHoCH. This will enable you to access their trading services and take advantage of the features they offer. Now let's take a look at some examples. If you find this content helpful, please like the video and subscribe to our channel. Your support will motivate us to continue providing valuable information. Currently, I'm analyzing the euro-dollar chart on a 1-hour time frame. The first step I took was to identify a supply position using the diamond flip pattern. I have marked the relevant supply areas on the chart. As you can see, the price has crossed these 2 areas, indicating that sellers have gained control. Based on this observation, I have specified the supply area and decided to open a sell position. To manage the risk, I have set a stop loss at a swing high. Additionally, for potential profits, I have placed my take profit level in the demand area. It's important to remember that trading decisions should be made after thorough analysis, considering various factors such as technical indicators, market conditions, and risk management strategies. Backtesting your strategy and implementing proper risk management techniques are also crucial to protect your capital. In this example, I'm analyzing the euro-dollar chart on the 1-hour time frame. Upon observation, we can identify an ascending change of character pattern. This pattern indicates that the price is currently being controlled by buyers. To take advantage of this pattern, I have identified a specific demand zone on the chart. I am patiently waiting for the price to reach this demand zone before entering a buying position. By doing so, I aim to capitalize on potential upward momentum in the market. To manage the risk of the trade, I will place the stop loss below the lower swing, ensuring that if the price moves against my position, my losses are limited. Additionally, I will set my take profit level in the supply area, where I anticipate potential selling pressure to emerge. I am currently analyzing the EUR/USD chart on the 1-hour time frame, focusing on a continuation pattern. As you can see, the market trend is upward. In this situation, I am looking for a break in the structure which I have specified on the chart. After conducting a thorough analysis, I've identified a demand zone where I intend to enter a long position once the price reaches that zone. To manage risk, I have set a stop loss based on low volatility to ensure potential losses are limited. Additionally, I have placed the take profit level in the supply zone, aiming to capture potential profits. I must emphasize that this setup carries a high level of risk and requires considerable practice. However, once mastered, it can provide opportunities for multiple positions in one day. The pattern I am discussing is one of the most commonly seen patterns in the market. If you haven't already, I recommend watching the previous video where I shared a technique that can help you utilize this pattern and potentially make significant profits. Your support is greatly appreciated, so please like the video and subscribe to our channel. I also encourage you to follow our Instagram channel, where we share the latest trading techniques, setups, and financial market analysis. I sincerely hope that this video and our content will have a positive impact on your trading journey. May you find success and blessings in your learning journey.